Thanks for sitting down with me to discuss your views on China and why you see an opportunity within the domestic stock market. For those that don't know Tim's background, you can find his bio on our website at phillipsandco.com. Let's jump in. With all the places and assets you can invest in, why land on the domestic China stock market?
Yeah, thanks, Scott, for hosting this conversation. And I really hope this format works really well for our friends and clients throughout the United States, as we really want to educate, inform, and collaborate. To jump to your question, why China matters, let me just pop up a few slides for us to share. Bear with me for just 1 second, Scott.
Great.
And we'll get into it. I think first things first, just forward PE ratios and China's growth rate relative to US. China is about 13.4 times forward PE. The US is in that 22 to 24 times. So basically there's this lower valuation you can capture by investing in China. The second area has to do with their growth. Their current PE of 13.5 compared to their GDP growth of 8 gives them that PE to GDP growth ratio of 1.7%. That's incredibly low relative to the opportunity China represents. I think the other thing is investors will need returns, especially institutional investors that have very large time frames and much higher target rates of return. Things like pension plans, endowments, and sovereign wealth funds all have demands on their assets and they need returns. Really, China represents that best opportunity for institutional investing. I mean, Scotty, just take a look at this one slide. This is one of the largest institutional consultants in the world, Cambridge Associates, and you can see up here, they've placed the China A-share market at the very top of their list for their institutions to invest in. I'm hoping US investors of ours can slide in front of that large mass of wealth.
Okay, let's take a step back and just give us a quick explanation of what is the China A market?
Yeah, it's another good question. I know for a lot of our clients and friends throughout the United States, they've never really been exposed to this concept. The China A market, simply put, is the equivalent of the US-based market, just domiciled in mainland China.
Okay.
It basically contains Chinese-based companies that have listed on their exchange to gain access to their domestic investors. In fact, at one point, the China A market, domestic market, comprised of 90% retail domestic investors. One of the other things important to recognize is it's the second largest stock market in the world. While the US represents $33 trillion in market cap, China well behind, but second largest at 8.4 trillion. It also is the third largest fixed income market in the world.
Okay.
So those are two really important reasons. The other thing for our friends and clients to recognize is that the China A-share market is grossly underrepresented within the indexes. So if you just look at this little sliver here in 2018, the China A-share represented less than 1% in the MSCI Emerging Markets Index. MSCI realized that, and they've been on a multi-year process of increasing their inclusion of the domestic market. Last year, they went to 4%. In the future, they expect to take that to 20%. And it's just important to realize China, relative to almost any measure, is grossly underrepresented in the world. And we think it's important for US investors to gain access to that rapidly growing market, especially as they want to gain access to that emerging middle class. And I'll just make this one key point. If you think about large US corporations like Apple, they need huge markets to keep those growth rates going. Functionally, the emerging middle class that will literally double in the next 10 years provides companies like Apple with that huge market to keep their growth rates going. So we need China as much as they need us.
And then, so one of the concerns investors might have is investing in a country like China with its Communist Party control. How do you think about that issue?
Yeah, that seems to be the biggest question we do get when we talk about China. And let me just peel away the onion just briefly for you, Scott, and get a little bit in the weeds. China is made up of about 1.4 billion people, but surprisingly, there are only really 90 million Communist Party members. And of that 90 million, there are probably only 20 million Communist Party members that work in the bureaucracy and help manage the country. It's their sincere desire to create stability for this 1.34 billion. Just imagine if there were no stability in that country, if there was no growth, if there was no prosperity, if there was no stability and safety, this 1.3 or 1.4 billion people would certainly look harshly on this 90 million. So for us, it's a very predictable formula. This 90 million people want to create stability and growth for this 1.3 billion. And in doing so, they're opening up their market. They're providing lots of benefits for other investors to come in and benefit from this large emerging middle class that is stably growing the next 10 to 20 years.
And right now, there appears to be a global reshuffling of power, especially economic power going on right now. How does China play into that paradigm shift?
Yeah, well, now you're getting to the issue, Scott, and the core and the heart of the issue. China, many years ago, launched this initiative called the Belt and Road Initiative. And that's their version of the Marshall Plan. If you think of post-World War II, where America went in and rebuilt Europe and rebuilt Japan with our Marshall Plan, it had huge economic benefits for US-based corporations. China has copied that plan in the respect that they've now gone out and are influencing the world with capital, with loans, with talent, with materials. And that benefits their influence outside of China, especially in Africa where they're making major headways, but also supports their domestic growth with better jobs and better talent. And just one little key statistic, China is now the largest trading partner in the world and has more trading partners than the United States does. The other thing is they've launched this initiative called the China 2025 initiative that targets specific industries, tend to be specific. Areas like agriculture, energy, biomedicine, high tech, aviation, and aerospace. These are all major industries that will help drive growth. Let me just put it to you this way, Scott. If you were able to buy Johnson & Johnson in 1950, just after World War II, would you, knowing all you know today?
Absolutely.
Of course. And that's exactly the opportunity we see. We see an opportunity to buy some of the world's fastest growing, largest companies, yet they're domiciled in China before they hit that global expansionist mode. Remember, the US is an America first contractionary model. China's in an expansion model, and we want to take advantage of that for our investors now.
Wow, that's a pretty bold statement. So what are the risks?
Yeah, along with all the normal investment risks you can have, clearly we have political rhetoric out of the United States administration as they try to push back on the growth. We have some information risk. Okay, how does a US-based firm like ours gain access to information? And there's a custodial risk. Where do our stocks sit? They sit in China, they sit in the US. Let me break those down. As far as political rhetoric's concerned, we're confident China represents such a big growth market for US-based firms like Apple and Walmart that those companies will certainly influence the US political administration. So we think it's much more rhetoric than it is real. As it relates to information risk, we've mitigated that risk by partnering with one of the biggest and best research firms domiciled in China CICC provides us all the equity research we need. And you can see on this slide, they're just simply award-winning across many standards. I think when it comes to custody risk, where do my stocks sit if you buy Chinese A-share stocks? Simply put, BNY Pershing, our custody partner, has facilitated for those stocks to sit in their US domiciled accounts. So not only do you get great access to research, but you also get to control your stocks here in the US. And we use the program called Stock Connect, which China introduced about 3 years ago. And more importantly, no one should overinvest in China. This should simply be a segment of your allocation as it represents emerging markets. If you have 15% emerging markets, you might want 5% of that in this focused domestic China market.
Great. Can you talk about the Phillips and Company China A-share separately managed account?
Yeah, great question, Scott. I really can't, because I really don't know who's going to be viewing this presentation. And this SMA is really for accredited investors only. So what I'd prefer is those that are viewing this connect with their advisor or an advisor at Phillips and Company Advisors. You can access those online on our website, phillipsandco.com. But we do hope that people take an opportunity to connect with one of our advisors and talk about why China matters.
Great. Thanks, Tim. This has been informative, and I hope to do this again with you in the coming months.
Yeah, Scott, thanks. I hope those that take their time to view this gain some insight and information about China. Also, on behalf of all of us at Phillips and Company, we hope everybody stays healthy and safe in this time of pandemic and turmoil. And we look forward to doing this again.